Financial reports, they can often seem like these dense, intimidating documents, right? Just packed with numbers and legal jargon. But what if we told you they're actually treasure troves, full of fascinating stories?
Absolutely. Stories about big strategic shifts, massive investments, sometimes even surprising legal fights going on behind the scenes.
Exactly. They're not just, rows of figures.
No, they're snapshots. Snapshots of a company's past decisions, their future plans. They reveal so much more than you might think at first glance. Kind of a unique window into the heartbeat of the business.
Precisely. So today, we're diving deep into Hyatt Hotels Corporation. We're looking at their recent financial performance, pulling insights straight from their latest Form 10Q filing.
Right, that covers the quarter and the first 6 months ending June 30th, 2025.
And our mission here, for you, the curious learner, is really to cut through all that complexity. We want to pull out the most important nuggets, deliver those aha moments.
Yeah, so by the end of this, you'll have a really solid handle on what's happening with a major player in global hospitality, quickly but thoroughly.
Okay, let's get into it. Let's unpack this. So, to really get what's going on, we kind of have to start with the big headlines from Q2 2025. And it's a bit of a tale of two numbers.
Definitely.
On one hand, you've got some pretty solid revenue growth. Total revenues for Q2 hit $1,808 million.
Which is up 6.2% from the same time last year, Q2 2024, when it was $1,703 million.
Yeah, and the report says this was mostly driven by higher gross fee revenues and also revenues for reimbursed costs. Looks like a strong top-line performance, right?
It does, yeah, on the surface. But here's where it gets, well, really interesting. While revenues went up, net income, that tells a completely different story, a dramatically different story.
Right.
For Q2 2025, net income attributable to Hyatt Hotels Corporation actually plunged to a loss of $3 million.
The loss, wow.
Yeah, I mean, think about that. That's a massive swing. A $362 million decrease from the $359 million net income they reported in Q2 2024.
Whoa. Okay, that's not just a dip.
Exactly. It really highlights how that top-line revenue number can sometimes be, well, misleading on its own. And it raises that big question. What on earth happened? How do you get that kind of contrast?
A loss after revenue growth.
No.
Yeah, that definitely makes you stop and think. So how do we make sense of those two numbers? They seem totally at odds.
Well, that's where adjusted EBITDA comes into play. It gives us let's say, a clearer picture of the operational performance.
Right, stripping out some of the noise.
Exactly. Adjusted EBITDA for Q2 2025 only saw a pretty slight decrease. It went from $307 million down to $303 million.
Okay, much less dramatic.
Much less. And what's fascinating is how these different figures, net income versus adjusted EBITDA, they paint a more complete picture when you look at them together. Adjusted EBITDA, it helps isolate the core operations, right? It excludes things like non-recurring items, non-cash charges like depreciation, amortization, and crucially here, gains or losses from asset sales or those big one-time transaction costs.
Gotcha. So it's like turning down the background noise to hear the actual engine running.
That's a great way to put it. It's the financial equivalent of removing all the static to hear the company's true operational heartbeat. And it's a key metric they use internally for their own assessments, even for like executive compensation.
Okay, so if adjusted EBITDA helps cut through the noise, what was the biggest noise factor hitting that bottom line, the net income, this quarter? What caused that huge difference?
Right. The main reason, the primary driver for that huge drop in net income was simply the comparison. You're comparing this quarter to 2024, which had some really significant one-time gains from selling off major assets.
Okay, so last year's number was artificially inflated in a way.
Exactly. Those gains significantly boosted the prior year's net income. Just for example, in Q2 2024 alone, Hyatt had a $257 million pre-tax gain from selling the Park Hyatt Zurich.
Okay, that's substantial.
And another $100 million pre-tax gain from selling the Hyatt Regency San Antonio Riverwalk, also in Q2 24. And if you look at the whole first half of 2024, there was also a $172 million pre-tax gain from selling the Hyatt Regency Aruba Resort Spa and Casino.
Right.
Plus another $231 million pre-tax gain related to something called the UVC transaction. That's their strategic joint venture for luxury all-inclusive resorts.
Hi.
So huge gains last year.
Right. The scale of those gains is
Yeah.
really significant. So take away those big one-off boosts and suddenly 2025's net income picture looks completely different, much less dramatic.
Precisely.
And if we connect this to the bigger picture, it really underlines Hyatt's strategy, doesn't it? This ongoing move to sell off owned real estate
Yeah.
and focus more on that asset-light model.
Yeah.
Management contracts, franchising.
They're using the cash from these sales to fund new stuff, pay down debt.
It's interesting, though, isn't it, how this kind of aggressive selling changes what a hotel company is. They go from being property owners to being, well, brand managers,
It's
operators.
almost a redefinition of hotel company in the modern era.
Yeah. And speaking of new investments funded by those sales, maybe the biggest move this past quarter was the Playa Hotels acquisition?
Oh, yeah. Massive deal. In Q2 2025, Hyatt paid, get this, $1,497 million in cash.
Almost $1.5 billion.
In cash. And they repaid another $1,078 million of Playa's existing term loan. So huge outlay.
And what did that bring in?
That brought 15 all-inclusive resorts into the Hyatt fold, spread across Mexico, the Dominican Republic, and Jamaica. Big splash in the all-inclusive space.
That is a massive deal. Okay, so what were the immediate sort of financial consequences? It must have cost a bit to integrate.
Oh, absolutely. A transaction that large, it naturally has an immediate financial impact. The report shows transaction and integration costs just soared. $65 million in Q2 2025.
Okay.
Compare that to just $10 million in Q2 2024. So yeah, those non-recurring costs hit that net income figure we were talking about earlier, dragging it down.
Right, makes sense.
But here's what's really intriguing, the follow-up. Hyatt has already signed a deal to sell the entire Playa Hotels portfolio.
Already, they just bought it.
I know. They expect to sell it for $2,000 million, which includes a preferred equity piece by the end of 2025.
Wow. Okay, that's not just a quick flip. That really underlines their commitment to this asset-light thing, doesn't it?
It really does.
It shows they're willing to make these huge, bold moves and then pivot really fast, even on a major acquisition, if it fits the strategy. Kind of signals a new level of agility.
It's a rapid strategic pivot for sure. And related to that Playa deal, they also recorded $1,697 million in goodwill.
Almost $1.7 billion in goodwill. Explain that a bit.
So goodwill, it's basically the premium Hyatt paid over the value of Playa's actual tangible assets, like the buildings and land. It represents the value they see in things like Playa's established brand, its customer base, and critically, the future growth opportunities they expect from strengthening their all-inclusive platform, securing those long-term management rights.
Got it. So it's the value of the future potential, essentially.
Pretty much. And just to round out the M&A picture quickly, they also mentioned picking up something called a variable interest entity, a VIE, in late 2024. That was for about $359 million, so roughly $374 million US.
A VIE, what's that exactly?
It's basically an entity where Hyatt has a controlling financial interest and significant influence, even if they don't own, like, the majority of the voting stock in the traditional sense.
Okay.
Plus, remember the Mr. and Mrs. Smith acquisition back in October 2024? That was for $151 million. They noted some measurement period adjustments for both that and the VIE deal, basically just refining the accounting as they finalize the exact value of all the acquired assets and liabilities post-purchase.
Right, fine-tuning the numbers after the deal's closed. So, yeah, lots of moving parts on the buying and selling front.
Okay.
So we've looked at the big financial engineering, the buying and selling, but let's see what's actually happening in the hotels, on the ground.
The operational health check.
Exactly. We can learn a lot from metrics like RevPR and net package RevPAR. Just to quickly define those for you listening, RevPR is revenue per available room. It tells you how much money a hotel makes for every single room it has. It doesn't matter if it was occupied or empty. Think of it like, I don't know, the ultimate efficiency score for a hotel. How well are they monetizing every room?
Yeah, that's a good way to put it. And net package RevPAR is similar, but it's specifically for the all-inclusive resorts. It looks at the whole package revenue room, food, drinks, everything.
So it gives a truer picture for that all-inclusive model, since so much of the revenue isn't just the room itself.
Exactly. It captures the entire guest spend. So looking at Q2 2025 versus Q2 2024, comparable system-wide hotels RevPAR, it increased 1.6% using constant currency.
Okay. Modest growth. What drove that?
It seems like it was mainly strong leisure travel, but specifically outside the United States. Group travel and business transient RevPAR were apparently pretty flat.
Interesting. So international leisure is holding up well. What about those all-inclusive resorts with the Playa acquisition boosting that segment?
Yeah, that segment looks even stronger. Comparable system-wide all-inclusive resorts, their net package RevPAR jumped an impressive 8.6%.
8.6? Okay, that's robust.
Definitely indicates strong demand, good pricing power there.
Yeah.
Particularly strong, they noted, in the Americas, but excluding the U.S. and also in Europe.
Right. And they're owned and leased hotels, the ones they haven't sold yet.
Those also saw a RevPAR bump, up 4.4%, primarily driven by strong group demand and also higher average daily rates.
So putting it all together, it really seems travel patterns are shifting. Leisure, especially international, and the all-inclusive segment seem to be the growth engines right now.
Yeah, and what's really crucial to understand here is how that RevPAR growth happens. Changes in the average room rate, charging more per night, that typically has a much bigger impact on profit margins than just changes in occupancy.
Right, because filling a room costs more in terms of service, cleaning, etc., but charging more for that same room is almost pure profit.
Exactly. If you can charge more per room, that flows much more directly to the bottom line with minimal extra variable cost. So seeing rate growth, especially in that high margin all-inclusive space, that's important for profitability.
Makes sense. Okay, so these big moves, acquisitions, they cost money.
Yeah.
How did they fund all this? What do the balance sheet and cash flow statements tell us about their overall financial footing?
Well, the balance sheet certainly reflects those big moves. Total assets surged. They hit $15,907 million dollars at June 30, 2025,
Up from?
up from $13,324 million dollars at the end of 2024. Big jump. And no surprise that growth was largely driven by the Playa Hotels acquisition, which massively increased goodwill and intangible assets on their books.
Okay, assets up. How about debt? You mentioned they took on Playa's debt too.
Right. So to fund this growth, long-term debt also increased significantly. It rose to $5,627 million dollars from $3,326 million. So yeah, they borrowed quite a bit, primarily to finance these acquisitions.
Naturally.
Yeah.
And how did that show up in cash flow?
As you'd expect, with that much spending, net cash used in investing activities went way up. Reflects that huge cash payment for Playa.
But they must have brought cash in from somewhere.
Yeah, on the flip side, cash flow from financing activities saw a notable increase. That's mainly from the proceeds of taking on that new debt we just mentioned, even though they were also doing some common stock repurchases, buying back their own shares.
Okay, so debt funded the acquisitions, which shows up in financing inflows and investing outflows. Got it.
And here's kind of a surprising little detail amidst all this big strategic movement. Capital expenditures, money spent just maintaining and upgrading existing hotels, that remained relatively stable. It was $74 million dollars for the first 6 months of 2025.
Hmm. So even with all the buying and selling, they kept routine CapEx fairly steady? Shows focus, maybe?
Yeah, perhaps a very focused approach to operational spending, even while making these huge portfolio changes.
Okay, now let's dig into some of the really unique details. The stuff that goes beyond the standard numbers, but can reveal some hidden complexities or interesting background.
Yeah, sometimes the footnotes are where the really juicy stuff is.
Exactly. So you might not think much about a loyalty program showing up on a financial report, but check this out. Hyatt has $1,469 million dollars in deferred revenue related to its loyalty program, World of Hyatt, as of June 30, 2025.
Wow, nearly $1.5 billion. That's a huge liability on the books. Basically, money they owe back to members in future stays or points.
It is. But what's even more intriguing, maybe, is this ongoing U.S. tax court case they mentioned. The IRS is arguing that the contributions hotels make into the loyalty program should actually be counted as taxable income for Hyatt Corporate right away.
Ooh, okay. That's a potentially big deal. Usually, that cash isn't taxed until the points are redeemed, right? Because it's deferred revenue.
Exactly. So this is a fundamental disagreement about when that loyalty money becomes taxable income. It's a crucial point for their future tax bills and what they call unrecognized tax benefits.
Yeah, that's a battle over how a core part of their customer retention strategy gets treated by the tax man. The outcome there could definitely have some long-term financial consequences for Hyatt. Big implications.
For sure. Okay, then there's the company's stock structure. It's a bit unusual, a dual-class structure. They have Class A shares, which is what most people trade, and Class B shares.
Right, and the Class B shares are primarily held by members of the Pritzker family, the founding family, and people or trusts related to them. They're permitted transferees, as the filing calls them.
And these Class B shares, they have different voting rights, right? But they also convert into Class A shares over time.
That's right. They convert usually when sold or transferred outside that permitted group, and then the company retires them. We even saw a recent example. They mentioned retiring about 364,000 Class B shares just on August 6, 2025.
So it's this slow, ongoing process.
It is, and it's a fascinating glimpse into how the company's deep history still influences its present. That dual-class structure lets the founding family maintain significant control and influence, reflecting their long history with Hyatt's direction. The conversions show a gradual evolution in that ownership structure, though.
Interesting piece of corporate governance history playing out. Okay, and finally, let's just briefly touch on how they pay their top execs.
Ah, executive compensation. Always interesting.
They use something called performance share units, or PSUs. It's a form of stock-based compensation. And the number of shares executives actually get depends on hitting certain goals.
Right, and those goals are key. What are they tied to?
The filing lists three main ones. Relative total shareholder return, basically how Hyatt stock performs compared to its peers. Average organic net rooms growth, so growing the system without just buying companies.
Yeah.
And the adjusted EBITDA to adjusted free cash flow conversion ratio, essentially, how well they turn operational profit into actual cash.
Okay, so it links pay directly to stock performance growth and cash generation. Makes sense.
And one other interesting detail, they specifically mention clawback provisions for detrimental conduct.
Ah, the clawbacks. Important for accountability.
Yeah, it means if executives do certain bad things, they list things like committing a felony, gross negligence, willfully violating company policy, the company can take back unvested PSUs.
So, what does this all mean, big picture, for incentivizing growth and accountability? It seems like it's designed to tie executive pay directly to the things that drive long-term value for shareholders,
Right.
like operational performance, smart growth, cash flow, and shareholder returns, while also having some built-in protection, those clawbacks, to ensure integrity. It's about aligning leadership's interests with the company's long-term health.
Okay, and with that,
Yeah.
wow, we've really peeled back the layers on this financial report, haven't we?
We have gone from just numbers to hopefully a compelling story about a pretty dynamic company.
Yeah, you've seen how selling off assets helps fund new ventures like Playa, how those operational shifts show up in metrics like RevPR, and even some of those intriguing details about, tax battles and stock structures.
It's like being a detective, right? Piecing together all the clues from the report to understand the bigger picture.
Totally. And it seems pretty clear that Hyatt is actively, really actively, reshaping its portfolio, leaning hard into that asset-light model, focusing on strategic buys in high-growth areas like all-inclusive.
Yeah, all while navigating some pretty complex financial and regulatory waters. They're definitely not just sitting back. They seem to be proactively trying to define their future shape.
So here's something to think about, a final thought for you to ponder. Considering Hyatt's really proactive strategy selling owned hotels while aggressively expanding management and franchising deals,
Hmm.
how might this whole trend reshape the competitive landscape for hotel companies in the next few years?
Hmm.
And maybe even more broadly, what implications could this shift towards asset-light models have for the future of travel and hospitality as we, experience it? Something for you to mull over and maybe explore on your own.